You're watching News.Markets. Prices for iron ore, copper, nickel and other metals have been in a multi-year slump amid sluggish growth in Europe, a weak recovery in the US and slowing growth in China and Brazil. The copper price, which is such a good indicator of global economic health that it's been called Dr. Copper, has now been falling steadily for almost 5 years. Well, here to talk about the state of the metals markets and where the opportunity lies is Carol Ferguson, Senior Research Analyst at SP Angel. Thanks ever so much for coming in. Now, look, do you think things are going to get worse before they get better?
Well, I must say it's very, very hard to work out where things are going. And part of the problem the market is having and why there's so much gloominess in the metals market is people can't see where prices should settle. So we know we've had the bad news, and we've had the bad news for some time to come. Everyone has realized that China is slowing down. And people are aware that China has been a huge part of metals demand, accounting for 50% of demand across most metals. The big problem we have is nobody seems to be able to really absorb all this bad news and say, actually, this is the bottom of the market.
So it's tricky to work out where things are going. But with the copper price, for example, where it's at, that's having an impact on some of the majors, isn't it?
Oh, yes, definitely.
With varied results.
Yeah, no, because copper has been a big bet for most of the majors because it's a metal that's very hard to find. It's been hard to find good mines, low-cost mines with good grades. So this was a sort of an area where it made a lot of sense to invest in and to have new mines, as Rio Tinto has with Oyu Tolgoi. Obviously, they've spent a huge amount of capital there on the basis that supply-demand fundamentals support copper. But unfortunately, with the prices where they are going to impact earnings. And Glencore, for example, has been one of the chief companies that's been vulnerable to the fall off in copper. It's very highly geared to the price of copper, and that's every time the copper price falls, the Glencore share price goes down.
Does that mean though that Glencore is an opportunity for investors, or if you have a different strategy, should you look at Rio Tinto? Talk me through it.
I prefer to go the safer route, because Rio Tinto has got iron ore predominantly, but it also has quite a lot of copper. And the great thing about Rio Tinto, unlike Glencore, is it doesn't have a leveraged balance sheet and it's paying you dividends. So, you can buy Rio Tinto now, earn a dividend yield between 6.5% and 7%, which is reasonably well covered, and wait. So at the moment, I think in the metals market, it's a bit of a waiting game. Most people feel we're at the bottom, but they don't know how long we're going to stay here. And so the best way to play this kind of part of the cycle is to buy companies that aren't leveraged, have low cost, good quality assets, and they're paying you to wait.
It does really seem that there aren't any winners.
Yes, no, absolutely. I mean, Glencore is trying to do the right thing by cutting back on zinc production. I mean, in fact, they've been talking about sort of supplier restraint, and trying to create a situation where we don't have so much supply of metals going into the market. And they, with zinc, Glencore's a big player in zinc, and they decided to cut back on production in zinc. And that, they made that announcement a few weeks ago, and the price of zinc rallied on the back of that. But after a while, it started drifting back. And it's fallen since then because Vedanta came out the other day and said, great, we see zinc is now going into a deficit because Glencore's cutting back on production. So we're going to ramp up production. And that means,
so lots of mixed messages and a confusing time for investors.
No, definitely.
Where would you direct them? What's exciting you? What is one of those safer bets that you talk about?
Well, I think, stay with the safer bets. So if you, for example, are very keen on copper, I think copper has good fundamentals. I would stay with companies that have low cost assets, and Rio Tinto, as I said, is one of them. And Antofagasta, if you're looking for a pure play, is a great play because if copper rallies, they're well positioned to rally and they are not leveraged. And this is the other thing. The market has really penalized companies with debt on their balance sheet at this part of the cycle.
So that's something to look out for.
Yeah.
Well, Carol Ferguson, it's always a pleasure.